What is Scuttlebutt investing? A research method where you gather on the ground intelligence about a company from competitors, suppliers, customers, employees, and industry experts before trusting the numbers. Coined by Philip Fisher in his 1958 book Common Stocks and Uncommon Profits. The core idea: financial statements tell you the past, people tell you the future. Why scuttlebutt? Old naval slang for the water barrel where sailors gossiped. Fisher used it to mean informed word of mouth intelligence, not rumor, no tips, structured, deliberated conversations with people who actually know the business. The five sources Fisher talked to: competitors, often surprisingly candid about who the best operator in their industry is. Suppliers, who know which companies pay on time, demand quality, and are growing orders. Customers, know if the product is genuinely superior or just well marketed. Ex-employees reveal culture, management quality, and operational reality. Industry experts, academics, understand where the technology or market is heading. His 15-point checklist, the framework. Does the company have product service with sufficient market potential to grow sales for years? Does management have a determination to develop new products when current one mature? How effective is the company's R&D relative to its size? Does the company have an above average sales organization? Does the company have a worthwhile profit margin? What is the company doing to maintain or improve profit margins? Does the company have outstanding labor and personal relations? Does it have outstanding exclusive relation depth of management? Does management have integrity? Does it communicate honestly when things go wrong? Is the company in a niche? What gives it pricing power competitors can't easily replicate? Famous wins: Motorola 1955, held for decades. One of his greatest compounders identified their R&D culture early. Texas Instruments spotted their semiconductor dominance before Wall Street understood the industry. Dow Chemical, long-term hold based on management, quality, and innovation pipeline. His general rule: buy right and hold forever. Fisher rarely sold famous failures and lessons. Fisher admitted he sold great companies too early multiple times. His biggest regret was exiting positions that kept compounding. Invested in a few turnaround stories that never turned. Learned that weak management rarely transform no matter how cheap the stock. His mistake pattern: trusting members over in early career before developing the Scuttlebutt method. Scuttlebutt versus standard research. Standard analysis: reads 10K, models DCF, assign target price. Fisher calls 3 competitors, visit a factory, talk to 5 customers, then read the 10K. The financial model confirms what the field work already suggested. Core principles: invest in businesses, not stocks. Understand the operating reality depthly. Management quality is everything. A great business with bad management destroys value. R&D and innovation pipeline predict future earnings better than current EPS. Concentration over diversification. Fisher held very few stocks. Diversification was his term for over diversifying. Never sell a truly great company just because the PE look stressed. Directly influenced Warren Buffett. Buffett called himself 85% Graham, 15% Fisher, but many argue Fisher's influence grew over time.